a fresh review. Reforms in the government securities market were aimed at improving liquidity and depth by broadening the investor base and ensuring market-related interest rate mechanism. The important initiatives introduced included a market-regulated government borrowing and consequently a phased elimination of automatic monetization of central government budget deficits. This in turn provided a fillip to switch from direct to indirect tools of monetary regulation. In fact, we talked today about the repo rates and the reverse repo rates. All this would not have been possible but for the deregulation of the interest rate and the modernization of the government securities market and allowing the government to go to the market and raise the funds through the auction mechanism. In fact, it is almost 2 decades since the banking reforms were introduced. But as one who was part of the team which was responsible for initiating banking sector reforms can say how traumatic it was in the first 3-4 years after the banking reforms were introduced. It is not easy for banks who have been telling their clients to behave properly to show losses on their balance sheets. In fact, we had to intervene very often and to tell tell the public that the losses are not because of the actions of the banks in a particular year, but it is the cumulative effect, and it is also because of the new rules that we have laid down. Many of the things that we talk about today, like provisioning, non-performing assets and so on, capital adequacy ratio, were things which were not talked about prior to 1991-92. The introduction of the prudential norms and regulations has considerably strengthened the Indian banking system, but I must say, as one who initiated these reforms, I must also tell that even though we now take them for granted today, it was not an easy thing to do at that particular time. The current international financial crisis has important lessons for the management of the financial system in general and for the banking system in particular. Regulation has emerged as a major factor in maintaining the solvency of individual bank institutions and preventing systemic risk. What stands out glaringly in the current international financial crisis is the regulatory failure in the developed world. The failure was twofold. First, some parts of the financial system were either loosely regulated or were not regulated at all, a factor which led to what is very often called regulatory arbitrage, with funds moving from highly regulated to loosely regulated segments. Examples of soft touch regulation were investment banks, hedge funds and rating agencies. Second, there was an imperfect understanding of the implications of the various derivative products on the parts of the regulators themselves. In addition, regulators failed to recognize the limits of financial markets. There was market failure which was not taken up or which was not adequately addressed by the regulators. It is ironic that such a regulatory failure should have happened at a time when intense discussions were happening in Basel and elsewhere to put in place a sound regulatory framework. There is a degree of consensus on how the regulatory framework should be reshaped. Some of the key elements that should be integral to a reformed regulatory system are well known, and let me repeat 3 or 4 of them. One, the regulatory framework should cover all segments of the financial markets. The rigor of regulation must be uniform among all segments to avoid regulatory arbitrage. 2, systemically important financial institutions should receive special attention. Apart from additional regulatory obligations, such institutions may be required to conform to stricter and enhanced prudential norms. Large institutions having operations across countries may require coordinated oversight of regulators of different jurisdictions. In fact, there is a proposal to prevent financial institutions, particularly banks, from going beyond a certain size so that the dilemma of too big to fail can be avoided. It is not clear at this point how practical this will be. This, of course, applies with special reference to the developed countries and not to the developing economies. Institutions may be required to set up buffers in good times to be drawn down in bad times. This may entail varying capital adequacy and provisioning requirements according to the phase of the business cycle. They may be allowed to rise and fall with the business cycle. And 4, excessive leverage in banks may be contained through additional supplements to the risk-based capital ratio. Also, there is a proposal to set a limit on the overall leverage ratio. Apart from protecting individual financial institutions, there is a greater focus on limiting systemic risk. Systemic risk may be defined as widespread disruption to the provision of financial services. In view of this, efforts are on to identify macro-prudential indicators and the appropriate tools aimed at containing systemic risk. Macro-prudential indicators include the aggregate indicators of imbalances, indicators of market conditions, and metrics of concentration of risk in the system. National authorities and international institutions are evolving the tools to reduce the risk in the financial system as a whole. The macro-prudential instruments that are used commonly fall into 3 categories. 1, tools to address threats from excessive credit expansion in the system. 2, tools to address key amplification mechanisms of systemic risk. And 3, tools to mitigate structural vulnerabilities and limit spillovers from stress. The Indian banking system has emerged strong as a result of the reforms introduced since the early 1990s. It is this which has enabled the Indian banking system to withstand the impact of the international financial crisis. However, as we move ahead, there are certain challenges, and I would like to highlight some of them. 1, capital adequacy. The Indian banking system remains well capitalized. The capital adequacy ratio for all scheduled banks is now estimated at 14.17%, well above the required 9%. This high ratio means that the implementation of Basel III standards will not pose much difficulty. However, public sector banks face a peculiar problem. Given the government policy of no stake dilution below 51%, capital for the public sector banks will have to come from the government budgets, banks' own resources, and from public issues. The availability of capital through budget sets a limit on the extent of expansion of credit by these banks. With credit growth between 15 and 20% per annum, if the public sector banks are to retain their market share, there will be need for continuous injection of capital into these banks. During 2010-11, the government provided capital support of rupees 20,000 crore to the public sector banks. As against 6,000 crore rupees budgeted for the current year, government will have to come in with supplementary demand for grants between 4,000 to 10,000 crores of rupees for meeting the capital requirements.